Welcome back. This episode is one I think is genuinely important, maybe the most important in the series for investors who are doing serious due diligence. We're going to talk about risk, not in a way that's defensive or minimizing, but honestly and directly. Because the investors I respect the most are the ones who want to know what can go wrong before they commit capital. And any manager who can't have that conversation clearly doesn't deserve your trust. Let's start with demand risk, because it's the most obvious one. Aviation demand is not entirely immune to economic conditions. In a deep recession, corporate travel does decline. Flight departments get cut, charter markets soften. The question is, how much, and does it undermine the investment thesis? The historical evidence suggests the exposure is real but moderate. In 2008 and 2009, business jet deliveries dropped sharply, but here's the important nuance. Based aircraft, the ones in long-term hangar leases, don't disappear when the economy weakens. They slow down. They fly less, but the aircraft is still there, still in the hangar, still paying rent. The rental income is far more durable than the operational revenue in a downturn. And the post-COVID structural shift, the permanent expansion of the owner base, means today's demand is less purely cyclical than it was pre-2020. The second significant risk is airport authority relationship risk. This one gets underappreciated. Airport authorities are governmental entities with political dynamics, changing leadership, and competing stakeholder priorities. A ground lease that looks solid today can become contentious if a new airport director has different priorities, or if a municipality has a political dispute with an FBO operator. Aviation Week has documented specific cases of expensive litigation between FBOs and airport authorities. This is a real risk, and managing it requires genuine expertise in airport authority relationships, not just financial engineering. The mitigation there is selecting airports where the relationship track record is strong and where the authority has demonstrated a history of supporting private investment in aviation infrastructure. And frankly, having experienced operators on the team who have navigated these relationships over many years. Relationships don't transfer on a balance sheet, but they matter enormously in the business. Construction risk is the third one I'd highlight. Development timelines in aviation are already long, and cost escalation in construction has been persistent. A project budgeted at X can come in at 1.2x if materials cost spikes or labor shortages delay the schedule. That compression and return matters, and the way to manage it is through conservative underwriting, not assuming everything goes perfectly, and through contractor relationships with proven track records in aviation-specific construction. What about competitive risk? The concern that larger platforms sweep into DFW and Orlando and compete directly. It's a risk, but it cuts both ways. If the large platforms are moving into our target markets, that's validation of the thesis, and it increases exit optionality. The competition for airport land is real, but by definition, a first mover who's already secured ground leases is protected from that competition. The competitive risk is highest for positions that haven't been secured yet. Once you have the lease, you have the moat. That's why the urgency around capital deployment into the best available positions matters. And the labor risk, which we cover in episode 26, is real, but manageable for operators who invest in workforce development proactively. The risks are real, but they're manageable. And they're the price of admission for an opportunity that, in our assessment, offers risk-adjusted returns that are genuinely superior to what's available elsewhere in the alternatives market right now. That's our honest view.